Most people are told that annuities, RILAs, ETNs, and other downside protection products are designed to keep them safe. But what rarely gets explained is how much those protections really cost in lost opportunity, complexity, and control. Let's start with annuities. These are insurance contracts, not investments, and that matters because the insurance company is always paid first. Your returns are typically capped, often exclude dividends, and are calculated using formulas that almost no retail investor can easily understand. On top of that, many annuities lock your money up for 7 to 10 years. And if life happens and you need access to your funds, surrender charges can eat away a big portion of your balance. Now let's talk about RILAs, or Registered Index-Linked Annuities. These are marketed as a best of both worlds product. Some market upside with some downside protection. What is not emphasized is that you only get that protection if you hold the product to the end of the term. If markets fall more than the buffer you choose, you still lose principal, and your upside is capped, even when markets are strong. So you take real downside risk, but your upside is limited by design. ETNs sound like ETFs, but they are very different. An ETN is not a fund that owns assets. It's unsecured debt issued by a bank. That means you are lending money to the issuer, and your return depends on that bank staying solvent. If the issuer runs into trouble, you could lose money regardless of what the underlying index does. That is a risk most people do not even realize they're taking in ETNs. Finally, there is the growing world of structured products, so-called downside protection strategies. These products often promise buffers against losses, but the fine print matters. Many only work if you hold them for a specific time period, and the upside caps are usually far lower than what you could earn by simply owning a diversified portfolio of stocks and bonds. Over time, those missed gains can be far more damaging to your financial plan than a normal market downturn. The big takeaway is this: protection is never free. With these products, you're almost always trading simplicity, liquidity, and long-term growth for complexity and marketing promises. Before you buy anything that claims to protect your downside, make sure you fully understand what you are giving up on the upside, how long your money is locked up, and who is really benefiting from the structure of the investment.